Okay, we're going to talk about adjusting accounts and something called adjusting journal entries. Before we do that, let's lay down some foundation. Okay, we can define accounting into periods of time. That might be annual, that might be semi-annually, quarterly, weekly, or whatever. This is why we have an income statement that says for the year ended or for the month ended, right? Or you could have an income statement that says for the quarter ended, for the week ended, right? As a matter of fact, there's actually one type of business that does financial statements at the end of each day. Does anybody know what type that is? What type of business that is by chance? Banking. Banking, they do a complete set of financial statements at the end of each day, or at least a lot of them do. Okay? So we can define accounting into periods of time. Okay? Now, you see this term called accrual basis of accounting. We haven't really talked about that yet, although I have been teaching it to you. We're going to talk about that here in a minute, but first I want to talk about the cash basis of accounting. Now, if we say we are going to use the cash basis of accounting, we recognize revenues when the cash is received. And we record expenses when the cash is paid. Now, is that how we've been doing things? Have we been using the cash basis of accounting? No, we haven't. Okay? The cash basis of accounting is not generally accepted accounting principles for the most part. Because you're going to find it would be very easy to manipulate financial statements if one used the cash basis of accounting. Okay? You could have your customers prepay you to build up your revenues, even though you haven't provided services. You could tell your accounts payable people to not pay things until the next year to try to keep your expenses low. You see what I'm saying? Okay? So the cash basis of accounting, we do not use that for the most part. It's not generally accepted accounting principle. What we use and what I have been teaching you is what is known as the accrual basis of accounting. The accrual basis of accounting. And with the accrual basis of accounting, we recognize revenues when they are earned. And when are they earned? When we provided the product or the service, correct? We talked about that with the revenue recognition principle, correct? So the accrual basis is what we use. We recognize revenues when they are earned, and we recognize expenses when they are incurred. Okay? So this accrual basis of accounting is the whole foundation to what we're going to be doing in Chapter 3 as far as making these adjusting journal entries that I'm going to teach you. Okay? We make these adjusting journal entries so that we can abide by the accrual basis of accounting. Does that make sense? Okay? Now, okay, let's come off and go to the document camera. All right? I want to talk through an example here. All right? Okay, let's read through this real quick. Okay. On December 29th, 2013, our company pays $6,000 cash for 6 months of auto insurance coverage for our fleet of company vehicles. The coverage is for the period of January 1, 2014 through June 30, 2014. Okay? Now, you have to prepay insurance, don't you? Right? You have to do this with your own automobiles too, right? If you could pay it after the fact, you just would say, well, I didn't have a car wreck in April, so I'm not going to get insurance for April, right? No, you have to prepay your auto insurance, all types of insurance, right? Now, I want you to see, if we used the cash basis, and again, I told you the cash basis is not generally accepted accounting principles. But if we used the cash basis of accounting, how would that look? Now, I have a timeline here, okay? And this is the period of December. This is the period of January, February, March, April, May, June, okay? Now, if we used the cash basis of accounting, the cash basis of accounting says you recognize revenues whenever you get the cash, and you recognize expenses whenever the cash is paid out. Correct? So if you use the cash basis of accounting with this example, I want you to see where you would recognize $6,000 of expense in December, because that is when the money went out. Do you understand that? But do you see how that is really, there's some problems with that. First of all, it's going to make our financial statements really erratic. This December monthly financial income statement is going to be really have a low net income because we had this huge hit of expense because we paid it then, right? And do you see it also? It's really not indicative of what is going on here, is it? I mean, if we paid $6,000 total for 6 months of auto insurance coverage for a fleet of vehicles, basically what is the cost per month of that auto insurance? $1,000, right? Wouldn't it be better no, let me back out here. Again, this is December, January, February, March, April, May, June. Really, wouldn't it be more indicative of reality if somehow you could recognize $1,000 of expense in January, $1,000 of expense in February, $1,000 of expense in March, $1,000 of expense in April, $1,000 of expense in May, and $1,000 expense in June? Wouldn't that really be more indicative of what is required each month to conduct the operations? Okay. Oh, just a second, okay. So what we're going to find out is, by us abiding by the accrual basis of accounting, this is going to be the situation that we help create, okay? And this really is, like I said, much more indicative of the reality of the situation. Now, I do want you to understand one thing that's very important. Some students mistakenly think in this situation you paid the $6,000 in December up front, and in this situation we created a payment plan where we pay $1,000 each month. No. In both of these situations, the cash is paid on December 29th of 2013. We haven't set up a payment plan. In both of these situations, the cash is paid in December of 2013. This is just the cash basis, $6,000 of expense is recognized in December, the month of payment, whereas with the accrual basis, we recognize $1,000 worth of expense in each of the 6 months for which we received coverage. Understand? Did you have a question, Marina?
Well, my question was just, even for both of them, wouldn't you kind of divide out December 30th and 31st? Because since you prepaid it, like you still recognize that it's happening the 30th and 31st.
Your question is good, is how do we recognize it before, like what happens in this month? Isn't that kind of basically what you're saying?
Wouldn't you take like some dollars and cents?
Yes, and we're going to talk about that.
Okay, cool.
We're going to talk about that, okay? Good question, okay? Now, if you go over to the computer, it gives an example that's very, very similar to this, okay? But I don't really like it because there's just so many months. I think students sometimes get a little bit lost in the numbers, okay? But you can look over that one if you like. I like the one that I just did on the Elmo a little bit better, okay? Now, we are going back to the document camera, we want to use the accrual basis of accounting so that this will be what is reflected on our financial statements, okay? Now, there's two principles that we are going to follow in doing this under the accrual basis. The first one is the revenue recognition principle, and we have talked about that many times, right? We recognize revenue when it is earned, not necessarily when the money comes in. We recognize it when it is earned, and when is it earned? When we provided the product or the service, correct? Now, there's another principle called the see here. Another principle called the matching principle. Now, you might have remembered from an earlier chapter when we were going over the assumptions and principles of accounting. You remember we came across the matching and I said, let's skip that and come back to it later? Okay, well now we're coming back to it. The matching principle states that we should attempt to match the expenses to the same periods in which they helped create revenues. Say that again. The matching principle states that we should attempt to match the expenses to the same periods in which they helped create revenues. Okay, going back to the Elmo. Now I want you to see where this would be a proper following of the matching principle, right? Because didn't that insurance coverage, if we match it to the periods in which it helped create revenues, it is $1,000 for each of those periods. Is that correct? I mean, if we wouldn't have had our fleet of vehicles, we probably could not have conducted the operations. We probably would not have generated any revenues. So the matching principle states that we want to match the expenses to the periods in which they helped create revenue. And that, for this example, would be January, February, March, April, May, and June. Are you with me? Now, what we're going to do so that we can abide by the accrual basis and follow the matching principle and the revenue recognition principle, we are going to learn about an adjusting journal entry. An adjusting journal entry. Well, first of all, I will abbreviate adjusting journal entries a lot by saying AJEs, okay? An AJE is an adjusting journal entry. What is an adjusting journal entry? Well, it is a type of journal entry. And you're going to find it has the same rules as the other journal entries we've learned. The accounts being debited need to come first, and then the accounts being credited. And the total of the debits need to equal the total of the credits, okay? It's going to be listed in the general journal with the other journal entries. It's just that this is a specific type of journal entry, okay? It does two things. It brings an asset or a liability account to its proper amount, and it recognizes a revenue or an expense, okay? So it does two things. It brings an asset or liability account to its proper amount, and it recognizes a revenue or an expense. You with me? Now, a couple of things about AJEs. We make adjusting journal entries on the last day of the period, okay? Now, I did not say the last day of the year. I said the last day of the period. Because some companies do AJEs every month because they make monthly financial statements. Some companies only do AJEs at the end of the year because they only do yearly or annual financial statements. But you always make them on the last day of the period. Does that make sense? Okay. Here's another thing about adjusting journal entries. The cash account is never, ever, ever, never, never, never part of an AJE. If I ask you to make an adjusting journal entry and you are either debiting or crediting cash, I guarantee you your AJE is wrong. Okay? I guarantee it. Okay? All right. Now let me show you something else about AJEs. And this is a Dave Krug special, so it's not in your book. I won't charge you extra. Okay? But this is something I learned when I was a student, or figured out when I was doing AJEs, and it served me well. Okay? Spell out the word real. Like Dave Krug is a real smart guy. Okay? And then draw a line down the middle of the word real. Okay? All right? Now, what do you think those letters stand for? Revenues, expenses, assets, and liabilities. Okay? All right. Every time you make an AJE, folks, it will affect one from the left side of the line and one from the right side of the line. What do I mean by that? Well, when you make an AJE, it'll either be to a revenue and a revenue and an asset, or a revenue and a liability, or an expense and an asset, or an expense and a liability. So you're never going to have an AJE where you like a revenue and expense are both affected, or when an asset and a liability are both affected, or when two liabilities are affected, or two expenses. No, 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 no. Always one from the left, one from the right. You with me? Now, going on further, all your AJEs will always look like one of the following. You'll either credit a revenue account and debit something else, or you will debit an expense account and credit something else. Okay? All your AJEs that you make will look like one of these. Okay? But again, it's always one from this side and one from that side. So when I show you that an AJE could look like this, where you credit a revenue, that means you'd either have to debit an asset or liability there, right? And when I show you that you're going to debit an expense, that means you'd either credit an asset or a liability, right? Because it has to be one from this side and one from that side. Cool? All right. Questions on that? Okay, now let's go back to the example that we were working through. Okay? Let's go back to this example. Okay? All right. Now, we know that this is the cash basis. We're not gonna do that, right? So let me do a little origami here. Okay. So this is what we want to do. Ignore that. Okay. This is still our situation, but what we want to happen is, so we can follow the matching principle, we want to somehow be recognizing 1,000 worth of expense in each of those periods. Does that make sense? Okay. Let's do that. Now, first of all, let's go back to the question that Marina asked. Okay? She asked, well, don't you have to do something in December? You know, don't you have to do something? Okay, let's go ahead and make the journal entry. Let's go ahead and prepare the journal entry that we would make on 12/29 of 13. Okay? Now, I want to warn you, this is not an AJE. It is not an AJE. But we do have to record this transaction when we paid $6,000 cash for 6 months of auto insurance coverage. Okay? Now, does anybody know what the journal entry would be? Well, we would credit cash because our company pays $6,000 cash, right? So cash is credited for $6,000. Does anybody know what will be debited for $6,000?
Prepaid insurance.
Prepaid insurance, very good. And that is an asset, is that correct? So that is our journal entry on 12/29 of 13 to record what took place. Now you might say, now wait a minute there, Kruger. You told us that cash was never part of an AJE. Well, that's true. This is not an AJE. This is just the journal entry we made for the cash payment. I'm going to show you the AJEs here in a second. Okay? Now, we also know it's not an AJE because it wasn't made on the last day of the period, right? Okay? So, let's do this. After we make this AJE, I'm going to zoom out a little bit here. Okay? After we make this I'm sorry, I said that wrong. Nobody caught me. Got to catch my words. Did anybody know I said something wrong there? Why didn't you say anything? Why didn't you catch me? Okay, well, I am pretty quick. You're right. Okay. After we make this journal entry, let's take a look at what the T account to prepaid insurance would look like. We'll say there was nothing in there before. Okay. So let's post this journal entry, not an AJE, but let's post that journal entry to prepaid insurance. Well, we would debit prepaid insurance for $6,000. Is that correct? I'll go ahead and put the date over here. I don't always do that, but would you agree? That is the journal entry we make, and we post that prepaid insurance has a $6,000 balance, correct? We have an asset on our books that when we do our 1231 financial statements, we have an asset on our book called prepaid insurance, and it's worth $6,000, okay? That would be just like, Derek, have you ever gotten like a gift card for your birthday? Okay, like from Best Buy or something?
Yeah.
Well, what if somebody gave you a $6,000 prepaid Best Buy gift card? That'd be pretty nice, wouldn't it? Okay? You have not yet enjoyed or consumed any of the benefits of that card. It is an asset, and that's kind of like this. Okay? Now, let's go back to this. If we paid $6,000 for 6 months of auto insurance coverage, basically what is the amount of auto insurance coverage for each month? What amount? $1,000. Now, in looking at this, let's fast forward in time, and we are now at January 31st of 2014. How much of that prepaid insurance has been used up or consumed? 1,000 of it has been used up or consumed at the end of January, right? For January's insurance coverage, right? It would just be like your prepaid gift card if you went and bought $1,000 worth of stuff, right? You've used up $1,000 of that benefits, okay? So we are at January 31st. But do you see where our prepaid insurance, if we don't do anything, it's still going to show that we have an asset of $6,000, and we don't, do we? Thus, we need to make on 131 of 14, we need to make our AJE. Okay? Well, let's make our AJE. We need to show how much of that prepaid insurance has been used up. And we need to decrease our asset by that amount. You told me correctly that 1,000 of the prepaid insurance was used up, right? So we have to decrease prepaid insurance. Well, prepaid insurance is an asset. It has a debit balance to increase it and a credit balance to decrease it, right? So do we debit or credit prepaid insurance?
Credit.
We credit it. So we credit prepaid insurance by $1,000. We are going to decrease it. Well, what do we debit? Does anybody know what we're going to debit for $1,000? An expense. Specifically, insurance expense. Are you with me? Now, does this follow the rules of AJEs? Yes, we debited an expense and credited an asset, one from each side, right? Is it made on the last day of the period? Yes. Is cash in it? No. But do you see how this rule might be beneficial if you're making the AJE? Let's say you go, okay, Dave, I know we decreased prepaid insurance, but I can't figure out what we debit. Well, prepaid insurance is an asset. So you're either going to debit a revenue or debit an expense. Well, debiting a revenue doesn't make any sense, right? So you see how that could kind of guide you towards what the correct AJE is? Make sense? Okay, so let's go ahead. After we make this AJE, let's post that to our T account. Well, we credit prepaid insurance for $1,000. What is the balance of that prepaid insurance account now? $5,000. And by golly, isn't that what the asset is worth at January 31st? It's worth $5,000. It's not worth $6,000. It's worth $5,000. So I want you to see that making this AJE did two things. And this goes back to an earlier slide you saw today. In this instance, it adjusted our asset to its correct amount, and it also was the mechanism for booking that $1,000 worth of expense into January. Because look at that AJE. Insurance expense is debited, increased in January. When we do our January income statement, it's going to show $1,000 worth of insurance expense. So it will reflect the situation that we wanted it to reflect when we talked about this situation up here. Does that make sense? You following me, folks? Okay. Now, before we leave this wonderful example, let's fast forward. And now we are at the end of February, 2/28/14, short month, right? Well, how much more of that prepaid insurance did we just use up for February? We used up another $1,000, right? Derek, would be like if you went in February and bought another $1,000 with your prepaid gift card. So we have to make another AJE on February 28/14. And do you see where it is going to look exactly the same? We are going to debit insurance expense for $1,000 and credit prepaid insurance for $1,000. Do you see where? Now, it's not $2,000. No. We didn't use up $2,000 in February. We only used up another $1,000. Okay? We consumed or we enjoyed the benefits of the other $1,000. So, once we make that AJE, we need to post it, right? So we credit prepaid insurance on 2/28. What is our balance of prepaid insurance after we make this posting? $4,000. And by golly, by gum, isn't that what prepaid insurance, isn't that what your asset is worth? At $4,000, you have $4,000 worth of an asset there. And this AJE also debited insurance expense for $1,000. So it was the mechanism for putting $1,000 worth of expense into February. Cool? Now, if your head's kind of swimming a little bit, you can come off the Elmo. If your head's kind of swimming a little bit, know that this chapter can be a little tricky. But the way you learn this chapter is to do your homework. I'm going to give you lots of AJEs to do. Okay? The more AJEs you do, the better you will get at it. Okay? Now, we've just kind of broached the subject here. Okay? And the next question you might have is, well, okay, we just spent a lot of time talking about the AJE for prepaid insurance in that example that we did. Is that the only thing we adjust? No. There are 5 types of adjusting journal entries. Okay? There are 5 types of adjusting journal entries. Number 1, there are adjusting journal entries for prepaid assets. Okay? Now that's the type we just did for prepaid insurance, right? Okay? But you could have the same sort of principles for prepaid rent or something like that as well. Okay? The second category of adjusting journal entries that we'll learn have to do with something called depreciation. Okay? The third type have to do with unearned revenue. The fourth type have to do with something called accrued expenses. And the fifth type have to do with something called accrued revenues. Okay? Now, that third and fourth and fifth type of AJE that you see up there, we are not going to talk about those at all today. Okay, those will be what we'll talk about next time. Something for you to look forward to. Okay? All right, so let's spend a little time talking about a little bit more time talking about this first category. And also know this. We spend a lot of time talking about the first category. The second, third, fourth, and fifth, they go a lot quicker. Okay, so don't wig out on me. Okay? Let's spend a little bit more time talking about that first category, a prepaid asset AJEs. Here is another example in your slides that looks really doggone similar. Okay? On December 1st, 2013, Scott Company paid $12 grand for insurance, and it is for the period of December 13th through May 2000. Let me say it again. It's good for coverage for December 2013 through the end of May 2014. Now, they've recorded the expenditure properly as prepaid insurance, which is an asset, on December 1 of 2013. Okay? What adjustment is required? What adjustment is required on December 31, 2013? Well, if this company paid $12,000 for insurance coverage for 6 months, basically what is their insurance per month? $2,000. So they need to decrease their prepaid insurance by $2,000 at the end of December. Remember, this is a different example. But they need to decrease their prepaid insurance by $2,000 at the end of December because they bought this at the beginning of December. And the coverage begins December 1st. And they need to book $2,000 worth of insurance expense into December. And this AJE accomplishes that, right? You with me? I think they show us some T accounts. When we initially bought that on December 1st and paid for that prepaid insurance, we debited it for $12,000. But the end of December, it's not worth $12,000. We've consumed $2,000 of it. So once we make this AJE, we can credit prepaid insurance for $2,000, and now our 1231 balance sheet will properly show an asset of $10,000 on its books. And this $2,000 expense gets booked in December. You with me? Very similar to the example we just did. A few different dates and amounts. Okay? All right. We're going to talk about another category that actually goes into this prepaid assets. But let's come off that for a second. Okay? Ross, are you 21? Okay. I ask, you'll see why. Okay. Let's say your refrigerator is empty. Okay? Let's say at the beginning of the weekend, you go buy 12 beers and put them in your refrigerator. Okay? Now, you put those 12 beers in your refrigerator. You tell your roommate you have to leave for the weekend. Okay? Well, you come back on Sunday night and you open the refrigerator and there are 4 beers in the refrigerator. Okay? Well, while you were gone, somebody consumed how many beers? 8. You put in 12. You checked how many were there at the end of the weekend, and there were 4. Obviously, somebody consumed 8 beers or 8 bottles of beer, right? Hopefully not in the same hour, and hopefully they didn't drive, right? You with me? That's pretty easy, right? Now, I want you to think of that example as we talk about the next example, which has to do with office supplies, okay? Office supplies. During 2013, Scott Company purchased $15,500 worth of supplies. They recorded the expenditure as supplies, and supplies is an asset. Now, on December 31, 2013, they did a count of supplies, and there was $26.55 worth on hand. You see where this is the same sort of question? Well, we have to ask, how much of supplies were consumed in that time period? Well, this isn't as easy of math, but do you see where the adjustment we would need to make is after we did that calculation, this company consumed $12,845 worth of supplies in 2013. So we have to decrease supplies or credit supplies for $12,845. And we booked that expense into supplies expense for $12,845. If you did a T account, when we bought the supplies, we had $15,500, right? But you check the balance of supplies at the end of the year, and you've only got $26.55. You have to make this AJE that will allow us to credit supplies for $12,845 so that we can show the true amount of the asset of supplies on the books. Does that make sense? So this right here is the AJE that we make. We debit an expense, we credit an asset. Make sense? Okay. Any questions on that? We have one more little topic we'll talk about in our time. Hang with me if your head's kind of swimming. Okay, the second category of AJEs we're going to discuss is depreciation. Okay? Now, it says depreciation is the process of computing an expense from allocating the cost of plant and equipment over their expected useful lives. Okay, let's come off that to me if we could. Okay? Now, you guys have heard the term depreciation before, have you not? Now, I want to caution you here because I'm going to tell you a common mistake that people make in regards to depreciation. You guys have probably heard it in the context of like the following. Jesse just bought a new car for $20,000. Well, as soon as she drives that off the lot and it becomes a used car, the value has gone down. Sometimes people say it's already gone down by half or something, right? Okay? That's kind of the context you've learned depreciation, right? Now, I want to caution you, and I'll say this more than once. Depreciation in the accounting sense is not, it's not trying to write an asset down to its market value. It is not. Because think about it. You drive that car for $20,000, okay? And let's say you bought it for your business, okay? So you bought a new car for $20,000 that you're going to use in your business. After 1 year, the market value of that car, what you think the market value is versus what Ross thinks, versus what Diana thinks, versus what Jack thinks, that could be 4 different amounts, right? So, depreciation in the accounting sense is not trying to write a fixed asset down to what we think the market value is. What depreciation is this. First of all, it applies to fixed assets. Things like buildings, plant equipment, automobiles, things like that. Okay, it's as opposed to it doesn't apply to prepaid insurance, prepaid rent. It doesn't apply to supplies. No, it's more long-term plant fixed assets like trucks and cars and buildings and conveyor belts and a drill press and a building. There's only one type of fixed asset that we do not depreciate, and that is land. We do not depreciate land. We'll talk about that later. Let's go back to your example, though. Jesse, let's say you buy this $20,000 car for your business, and let's say you think it's going to benefit the business for 5 years. And then let's say at the end of 5 years, you probably don't think the car is going to be worth anything, okay? Well, doesn't it make more sense if somehow, if you think that $20,000 vehicle is going to benefit your business for 5 years, doesn't it make more sense if somehow you could end up expensing it or showing the consumption of it over the 5 years, and in this case, $4,000 per year? Does that make sense? Because that is the matching principle. That will match the expensing of that asset to the true periods in which it helped create revenue. Does that make sense? So in that case, if you paid $20,000 for a vehicle and you thought it would benefit the business and help provide, help incur revenues you needed in your operations for 5 years, you would depreciate $4,000 each year. You with me? At the end of year 1, though, I'm not saying that the truck or the car is worth 16 grand. I don't know. I'm not making that claim. Depreciation is simply spreading the expense out over a reasonable period of time. If you expensed that whole truck when you bought it, that would be a huge hit to your financial statement, right? And it wouldn't be proper following of the matching principle because that expense would not have been matched to the periods it helped create revenue. You following me? So depreciation has to do with fixed assets and allocating or spreading that expense over a reasonable amount of time, not with writing things down to the market value. So going back to these slides, okay? Let's do an example. On January 1 of 2013, it seems like I missed a slide. Okay, no, I did miss a slide. Okay, or I forgot to talk about this portion right here. How do we calculate depreciation expense? Well, we take the asset cost minus what we call the salvage value, or sometimes it's referred to as the residual value. That's what we think we could sell the asset for at the end of its useful life. In the example we just did, Jessa, we used 0. Okay. But let's say you think you'll be able to sell it for something at the end of its useful life. That's its salvage or residual value. So we calculate depreciation by taking the asset cost minus the salvage value divided by the useful life of the asset. And that's just an estimate. Okay? Now let's look at an example. On January 1 of 2013, Barton Inc. purchased equipment for $62,000 cash. The equipment had an estimated useful life of 5 years, and they expect to sell the equipment at the end of its life for $2 grand. Now, in this case, that $2,000 cash that they think they can sell it for at the end of its life, that is your salvage value or your residual value. Let's record depreciation expense for the year ended December 31, 2013. Well, how would we calculate that? Well, we would take the cost of the asset, 62 grand, minus the salvage value of $2,000, divided by 5 years. And thus we would depreciate $12,000 per year. Are you with me? Mpo.
So then can't people manipulate figures like that with saying that they expect something to have a residual of more than...
That's a great question. What Mpo asked is, he's recognizing that there are 2 estimates in that equation, looking at it. This number right here is an estimate, and the other estimate is this number, the estimated useful life. Those are estimates, aren't they not? Now, some people think accounting is all black and white. And here are 2 estimates. And you're right, there's some subjectivity to that. So what Mpo asked very wisely is, couldn't you manipulate this by having unreasonable estimates? Well, coming off that screen, the answer is yes, you could. However, it's kind of like your taxes. Do you do estimates when you do your tax return? Yeah, you do. Now, what happens if you make unbelievably unreasonable estimates?
Audited.
Huh?
You get audited.
Yeah, then it's going to be a red flag and you may get in trouble. Now, the IRS provides you some guidelines, right? Like, for example, I can take it, if I donate some old clothes of mine to Goodwill, I can deduct that, can't I? So what if I, at the end of the day, this blue shirt, I donate it to Goodwill, I can take a tax deduction for that, right? But I have to ask myself, what's the market value of this used blue shirt? Well, what do you think?
$10.
Maybe 10, probably not that much if you know what I pay for my clothes.
Sell them for like $3 or $4.
$5, $6. What if I said, well, I want to get a good deduction on my taxes. The fact that I wore this on camera. I mean, this thing's got to be worth $100. I'll even sign the tag. Well, I could do that, and I am manipulating my tax return. What happens if the IRS comes in and they see that I deducted $100 for the shirt? I could get in trouble. Okay, the IRS provides guidelines as far as how much to deduct for those sort of things. Going back to depreciation, there are accounting bodies that help us provide that provide guidance to help us make these estimates. For this automobile or this piece of equipment, 4, 5, 6, 7 years is probably reasonable. If you did it for 20, that's not reasonable. Okay? But they give guidelines as far as assets and what's a reasonable estimated life. And the same thing with the residual value. But you know, whenever you make estimates, you got to be able to defend them if need be. Jack.
Going back to the car thing, can a car depreciate in value if it isn't sold from like the dealership? Like if it's been on the lot?
Yes. That's a great question. Even if I bought a used vehicle, I would have to record depreciation. Okay? Now remember, I'm not trying to write it down to market value, but I do have to expense that asset over a reasonable amount of time. Okay? All right. I only have a couple minutes left. So let's look at this screen again, the computer. Now what you might think, the journal entry that you think I might make after, okay, it's $12,000 per year. What you think I might do is this. Depreciation expense, $12,000. And what you might think is that what I would credit is the asset of equipment, because that would follow the same logic as what we did with prepaid insurance and supplies, right? However, that is not the journal entry we make for depreciation, and that's why it's in its own separate category, okay? The journal entry that we make for depreciation is this right here. We debit depreciation expense and we credit a new account called accumulated depreciation. That journal entry spells out the word dead. I remember that from when I was a student long ago. D-E-A-D spells dead, okay? We debit depreciation expense and we credit a new account called accumulated depreciation. Now, whenever I introduce a new account, the first thing you should think is, ooh, I should make a new flashcard. Because I love to ask on tests what type of account it is, what's its normal balance, what financial statement does it go on? Because if you don't know how to answer those three questions, you usually don't know what you're doing. Okay? Looking at accumulated depreciation. What type of account is accumulated depreciation? Well, looking at the screen, it is what we call a contra asset. We've never talked about anything that was a contra asset before, but accumulated depreciation is a contra asset. Okay, back to me. Have you ever heard the word contra before? Yes, like where?
I want to say macro.
Maybe in economics. Contra, it is a root word that, what does the contra mean? Well, we contrast, contradict. It means the opposite. So if you say, I think the Royals are going to win the World Series this year, I might say, I'm going to contradict you. I'm going to take the opposite opinion. I think they're going to be bad. Okay? Contra means opposite. So we know an asset is a debit balance account. So what do you think is the normal balance of a contra asset account?
Credit?
It's a credit balance. Now, how does a contra asset look on, it's a contra asset, so it goes on the balance sheet with assets. How does it look on the balance sheet? It looks like this. You list out your asset. Now, we didn't affect the asset, right? Our AJE did not debit or credit equipment. So equipment is still $62,000. But then we subtract this contra asset, accumulated depreciation. We subtract $12,000, and this is what we call the book value of the asset. The book value of an asset is the cost minus the accumulated depreciation. Are we saying that we think that asset at December 31st, 2013 is worth 50 grand? No, we are not. Okay? We are just saying that is the book value at that point. But we do not credit equipment. We credit an account called accumulated depreciation, which is a contra asset account with a normal credit balance account, and it goes on the balance sheet as is shown here, and it's deducted from the asset to arrive at the book value. Does that make sense?